Valutrades, forex CFDs and commodities.
Good evening, everybody. It's Paul Wallace here. I hope you can all see the slide. I hope you can all hear my voice on this rather sort of warm and balmy evening in London. It's Tuesday, 22nd of August, and tonight we're here to talk about how to trade better using stop losses and take profits. So, as always, before we get into the main gist of our session this evening, we'll just start with a very quick risk disclaimer. CFDs and FX are leveraged products and carry a high level of risk to your capital. It is possible to lose more than your initial deposit, and you may be required to make further payments. These products may not be suitable for all clients, so please ensure you fully understand the risks involved. So what am I going to talk to you about for the next 30 to 40 minutes, ladies and gentlemen? Well, what I'm going to talk about is start with talking about two of the major rules for any type of trading. Doesn't matter whether you are an aggressive, short-term, intraday, euro-dollar 5-minute chart trader, or whether you're a sort of a slower trader off the weekly charts on gold, for example, or taking longer term positions. There's two major rules that we utilize for any kind of trading. One of the questions we always have to ask ourselves is about where are the exits, and that will become a little bit more understanding once we have a look at some of the slides that we've created here for you. We're going to talk about different types of stop losses, and we're going to give you also insight into types of take profits. We'll talk a little bit about trade management, and what I'm also going to talk is about other types of exits, namely physical versus psychological. We'll take some Q&A, but as always, if you have any questions as we go along, be sure to type them into the chat box that you have there on the system, and we'll be happy to sort of take those questions and answer them either now or we'll get back to you with one of our support staff will get back to you with a sort of a deeper understanding. And if there's time at the end and if there's interest from people, we can do a little bit on market analysis. It's normally August is a rather sort of, let's say, dull and quiet month, but it's not been the case this year. It's a lot of people talk about how years that end in 7 can be very, let's say, volatile and almost rather interesting years with regards to ends of bullish trends. So we can have a little quick look at some of the charts on the Valutrades at MetaTrader 4 platform and just have a look at one or two of the big, the actual big charts, the big currencies, and see what's been going on and what's setting up for the next couple of weeks. So, as all said, we'd start with talking about two rules of trading for any type of trading. And very simply and very bluntly, here is rule number 1 for any type of trading that you do. For any type of trading, your rule should be that you live to fight another day. What does that mean? That means that you don't put yourself in a position where your trading career sinks like the Titanic. What you have to do is to understand what is required to do that. Even if you make a mistake, because we're all human, we all make a mistake. Even I've been known to make a mistake, and I've been trading for for more years than I care to remember. We're all humans. We will make a mistake, and it's understandable. But what we also always have to do is to put ourselves in a position whereby we can always live to fight another day. Even if we have a challenging day, even if we have a day where we make mistakes, we still should be in a position to be able to come back and trade the markets tomorrow. And that's the sort of first rule that we always need to live by. Live to fight another day. And if you don't believe me, well then believe George Soros. He's a rather successful hedge fund manager. If you don't know who he is, well, he's been a very successful trader for probably about 40 odd years now. His probably crowning glory was making $1 billion in the day on breaking the Bank of England in the early 90s. But he's supremely successful, supremely wealthy, and I look at this quote where he says, "My principle is to survive first and make money afterwards," and that's absolutely right. Even George understands that first rule is live to fight another day. Okay, doesn't matter whether you've had a good day or whether you've had a challenging day. Okay, your first rule should always be live to fight another day. Make sure that whatever happens today means that you can still come back and engage with the markets tomorrow, because trading is an endeavor whereby you need to be able to sort of trade day after day, week after week, month after month, quarter after quarter. That is the way we like to work and trade. Here's another great quote from a friend of mine and an excellent trader, John Carter, where he says, "Amateur traders focus on how much money they can make on each trade. Professional traders focus on limiting risk and protecting capital. Professionals always take money away from amateurs." I've always loved this quote. I think it's absolutely fantastic, and it really gives you a fascinating insight into how amateurs and professionals would view the market. But let me just give you a little bit of insight here, ladies and gentlemen. When we talk about amateurs and professionals, normally new traders think that means that amateur traders are, let's say private retail traders, and professional traders are the guys and girls who are working on desks at banks. Well, let me make you very clear to you that, as someone who has worked at institutions and worked with retail traders, someone who has, sort of helped and supported traders across the entire spectrum, the term amateur and professional is not really limited to the actual, let's say, the role that particular trader places. I've worked in banks with very amateur traders, and I've worked with private traders who are supremely professional. Professional is about your attitude, it's about your mindset, it's about the way you respect the market and respect your efforts and the way you conduct yourself within the financial markets on a day-by-day basis. And the fascinating thing is that for yourself, that is something you can choose. Okay, being a professional trader is not about having the fanciest computer software, or having the biggest account, or having the fastest internet connection. Being a professional trader is all about your attitude. It's about having a process. It's about having discipline. It's about having self-awareness. And all of you can choose to have those in your let's say your trading experience, whether you've traded for 2 days or 2 decades. That's a choice that you can make. So if we have this rule of live to fight another day, how can we actually do that? What does that actually, how do we turn let's say a phrase or a quote like that into something hard that we can do on a day-by-day basis? Very simply, ladies and gentlemen, you're in a position to do these 2 very simple things. Always use a stop loss to ensure against catastrophic loss, and always limit your risk exposure to a small portion of your capital. I'm going to say those again because they're so important. Always use a stop loss to ensure against catastrophic loss, and always limit your risk exposure to a small portion of your capital. I guarantee if that you're able to do those 2 things religiously on a day-by-day basis, then you will always make sure that you live by that first rule, which is namely live to fight another day. So I appreciate that some of the people on the call here may be completely new to trading and may not completely understand what even a stop loss is. So I think here we go. We've just put a slide in here just to help you understand that. Here we have on the right side, I've just taken a little bit of a screenshot from a chart from a trade. What is a stop loss? Well, stop loss, if you want the sort of academic qualification or the academic definition, is about an order to sell an instrument at a specified price in order to limit a loss. What does that actually mean in reality? Well, as I said, here we go. We've got a little chart here. I think this is a trade of mine from a while back on the US dollar yen. And just let's say the trade plan here is that the dollar yen has been in a nice uptrend. The price pulls back where you can see the blue candles. We finished that pullback with a nice blue bullish pin bar there. And my decision is that I wish to be a buyer of that instrument, in this case, the dollar yen. So, of course, I need to get into the market, and to do that, I have an entry order, which is just above the high of the blue pin bar there. But also, what I want to do is to have another order in the market that basically gets me out at a price in order to limit my loss should the trade not work out in my direction. And what I've decided there is, hopefully you can see the sort of the yellow level for the entry order, and also a yellow line underneath the pin bar that is my stop loss. And what that is that's effectively an instruction to the market, an instruction to the broker that if price doesn't continue upwards, if price turns around and moves down, well then once price hits that level, then I wish to close my position. I wish to limit my loss. And it's enormously important to make sure that you have these stop losses in place. Because with the best will in the world, now and then things change within the market, and even the best laid plans of mice and men can sometimes turn against us. Sometimes for absolute reasons that we have no idea or reasoning behind. But actually, it's important that we manage our risk every single time we engage with the market. So if we have an entry order, there should always be a stop loss order with it also. And if there's one thing I've learned over nearly 20 years of trading is that, in order to live to fight another day, if you're not managing risk, well, then you're likely to end up as roadkill. Now, I'm being a little bit humorous there, maybe a little bit facetious there, to sort of make light of it. But the reality is very, very truthful, ladies and gentlemen. It's enormously important as a trader that you are always continuously looking to manage your risk. It is supremely important. Because if you don't, well, then you'll probably get yourself into a few problems. And if you get yourself into a few problems, then invariably you sort of struggle to effectively to fulfill that first rule, live to fight another day. That's what we always want to do. Regardless of what might happen in the market, regardless of what mistakes we may make, we always need to be able to live to fight another day. And as I said, we're in a position to do that by ensuring we always use a stop loss, and that we always just limit our risk exposure to a small portion of our trading capital. So that was the first rule. What's the second? Well, as you can probably read on that screen at the moment, second rule is never ever find yourself in a trade without an exit plan. That's it. Never ever find yourself in a trade without an exit plan. What does that mean there? Well, thankfully, I'm going to explain that to you now over the next few slides and give you some great insight in that. The important thing is that you always know where are the exits. So when you get on a plane to go on your summer holidays, they always start before the plane even takes off. They will start with a safety briefing, and they always point out where are the exits. If you work in a big building, I'll assure you that there will be posters up around the building. You'll have fire marshals who will always point out where are the exits. And it's the same with trading. We always need to know where our exits are. So it's important that we understand that, we know where they are, and that we're not in a position whereby we are in a trade in a way that I would define as being naked. Namely, we have an open position, but we don't know where our exits are. So when it comes to exits, what type of exits do we have available? Well, I see it in the most simplest terms is that we have two types of exits. Where we get out when we're wrong, and where we get out when we're fortunate enough to be right. That's about understanding where we want to get out of the market, where our trade plan hasn't worked, and also where do we get out when we're actually fortunate enough to be right, when we're actually fortunate enough that the market moves in our direction and takes us along with it. I always like this quote from a friend of mine, Curtis Faith. He was one of the original turtle traders. If you're not sure of that or understand that, he wrote a great book called The Way of the Turtle. If you ever want to see a sort of a Hollywood version of it, then you can watch the sort of 80s movie Trading Places, which will give you a little bit of insight into this. But what Curtis talks about is that, he says in this quote, we thought that each trade possibly could be a winner, but that most probably would be a loser. Well, why is that important to us as a trader? Well, part of that is about managing your own confidence, and part of that is about managing your own self-belief as a trader. And those are topics that are, that we could spend the next 3 or 4 months talking about, and we'll touch upon in future webinars. But why? One of the important things is I talked about before was being a professional trader is a lot about having the right attitude. And a lot of that about having the right attitude is about having the right mindset, and to do with that, the right expectation. And if you go into a trade with the expectation that you think each trade possibly could be a winner, but that most probably would be a loser, what that does is that frees you up. Okay, it stops your ego stepping in and trying to insist on you being right, trying to sort of project your needs and egos onto the market. It takes the pressure off your shoulder, okay, if you think that your trade possibly could be a winner, but most probably would be a loser. Now, when you're a new beginning trader, that might seem a little bit of a challenge to understand. You want to win on every trade. Most of us are competitive. We want to win on every trade. We want to be profitable on every trade. But what we realize is that it's like the oceans of the sea. The market is like the ocean in that there is always an ebb and a flow going on. The tide is coming in and the tide is going out. And some days we catch the tide, other times we don't. And it's about managing that expectation and that belief, and managing our ego, managing our competitive streak, which will help us manage our confidence and self-belief as we go forward as traders. So we talked about there's sort of two exits. Where we get out when we're wrong being the first one. So what does that mean? Well, we touched upon that in a few slides back, namely that there are multiple types of protective stop losses. Okay, so here we go. There's lots of them. You'll have technical analysis stops, which is an element of what we just looked at there, where I showed you that chart of putting your stop loss just beneath the low of a pin bar. You can have financial stops. So some people will have a set risk parameter by which they will only risk, be prepared to risk a certain financial number on a particular trade. Some traders will have discretionary stops, whereby they will look to use that based upon their own particular discretion. My own advice is for new traders is that's not the smartest way to go forward. What you want is a very simple and almost very mechanical way to set your stop loss. Some people will set psychological stops, namely that when either a price hits a particular psychological level, or they reach a certain, let's say, a certain level in their own psychological comfort, that they will stay with or exit a trade. Once again, it's my job to make you aware of this, but it's also my job to say that that is not necessarily a rather professional way to go about your trading. And as I said earlier, it's about choosing to be a professional rather than an amateur. Some people have volatility stops. Can that mean? Well, sometimes that can mean understanding what is the volatility within that particular market and making sure that your stop loss is in a place that it is outside of that volatility. So in one of our past Valutrades webinars, we talked about the average true range and how useful that can be for a trader. So if we know that the average true range for the euro dollar on a certain day is 70 pips, well then, we may choose to have our stop at, let's say, 2 times the average true range. Okay, so in which case, let's say if it's 70 pips a day for the average range for euro dollar, and we want to have a volatility stop loss at 2 times that, well then our stop loss is 140 pips weight, because we know that is likely to keep us outside the majority of the movement within that particular day. Some people will like to use percentage-based stops, although in my experience this has tended to be more to do with investors rather than traders. So an investor may take a position in, let's say something like Amazon stock, and they will have a percentage stop loss that trails behind their position by a number, maybe somewhere between 15 to 20%. Namely, if price pulls back 15 to 20%, they will exit that position. Some traders, especially shorter term time traders, and I use these sometimes myself, will have a time-based stop. Namely that if the position hasn't gone their way within a certain, let's say, time limit, could be 15 minutes, could be an hour, could be 3 days. If the position isn't profitable by that particular level, then what they do is they actually close out their position. Why would they do that? Why would a trader do that? Well, the trader might be a momentum trader. That setup might have been a momentum setup, and actually the trader was hoping that momentum would come back into the market and take the market in his preferred direction swiftly and easily. It's lovely when that works, but sometimes it doesn't. And sometimes having a time-based stop allows you to make a very simple mechanical decision whereby, let's say, for example, as an intraday trader, you say that, if the market hasn't, my position hasn't gone profitable within 60 minutes, well, then I will now close my position. And the reason they're doing that is because they want to manage their capital. They want to basically stop any mistakes. They want to just stop their position going against them. Remember that first rule: we always live to fight another day. So what I find and determine is that the majority of private traders that I talk with and work with, they are using technical analysis to define where they place the stop loss order. But even if you just use technical analysis, well, then there are actually various types of that. So some people will use pivots. There are a certain level of equation that can be placed on the market every day or every week or every month, and people will put their stop losses behind a pivot, which can in many ways be very similar to a support and resistance level in the market. That support and resistance level might be static, like a horizontal level, or it may be dynamic. It may be a dynamic support and resistance level, like a trend line that extends, or a particular moving average, which leads me on to the next one. Moving averages can be seen as a dynamic level of support and resistance, and people will place their stop losses behind them. Intraday traders may place their stop losses behind the previous day's highs and lows, knowing that if price is unlikely to touch them, that will be a safe place to have their particular stop loss. Some will have particular trailing stops that might be using something like a parabolic SAR or PSAR indicator that you can use on the Valutrades MetaTrader 4 platform. Other traders might use something like a congestion area. Once they're able to see where price maybe finds itself in an area of range-bound activity where it looks like it's congested, people may put their stop loss the other side of that. So there are many different ways you can use technical stop losses. What I would implore you to do is to find something very simple that you can replicate trade after trade after trade. I'll assure you there is no perfection in terms of placing either stop losses or taking profits. But what you need to do is to find a very, very simple way that you can replicate and follow every single trade, because that's actually the best way for you to operate. So we talked about where do we get out when we're wrong? So let's talk about on the flip side, where do we get out when we're fortunate enough to be right with our trade? Well, there's lots of different ways that you can exit when your trade is right, but when I boil them down to the sort of two simplest ways to define them, I define them as either having a target or having a trailing. So as you can probably imagine, a target is namely, a bit like that guided munition. We have a designated target in place and we look to hit that, and once that target is hit, we are out of the market for a profitable trade. On the flip side, we may be somebody who likes to use a trailing profit stop, which allows us, hopefully, a little bit like the trawler in the chart, to actually sort of gather up a bigger haul, shall we say, a bigger profit from that particular trades. So let's take a little bit of a look at them in more depth. So when it comes to using a target for your trade exit, what benefits does it give you? Well, one of them is an element of certainty. What does that mean? Well, once your trade target is in your platform, it can stay there, and you know that if the trade works, then it will hit that target and you'll be out. It also provides you the ability to be hands-off. Maybe you work during the day and you just place your trades in the morning, and you're allowed to put your trade on. You have your stop loss, your exit where you're wrong, and also a target to exit automatically when you're right. The MetaTrader 4 platform provides the ability to do that very, very easily. In many ways, it also takes less time to manage a position, because quite literally, you can just effectively put your entry order on, your stop loss exit order, and your profit target exit order. So invariably, you're using less time. And if you're using less time, well, that can also have an implication in using less of your psychological capital. If you're an intraday trader and you're having to watch your trade, well, I can guarantee it, that you'll be sat on the edge of your seat watching your trade tick by tick, going up and going down. And that can burn you up your emotional and psychological capital. Trust me, I know. I've done that for when I worked for hedge funds in the past as an aggressive intraday trader. You end up spending an awful lot of your time just sat on the edge of your seat watching your trade, seeing if it's going to work out your way or not, and that burns up emotional capital. If you're having a target from the get-go, from the start of your trade, well, that means there's less opportunity for interference. For many people, that's actually the best thing that they can do, because invariably, if they sit there, like I just described, on the edge of the screen, watching the trade, going back and forth, then what happens is that their ego feels a need to interfere. They get the impulsive needs to interfere. Why do we do that? Because our ego is telling us that we know best. That's what it is. Our ego is telling us, our ego is trying to wrest control, by telling us that we know best. And the reality is, actually, most of the time, we don't. So with all of that in mind, that means that sometimes having a target is easier to follow for some traders. If it means that you're going to just almost like set and forget your trade, you put your trade on, your stop loss exit and your profit exit, that means it's easier to follow. You can almost set that trade, just check every day that the trade orders are still on the platform if you're a longer term swing trader, and then just let the trade play out. And for many people, that is actually the best way that they can physically trade. So what's on the flip side? We've just looked at targets there. What is it about with a trailing stop? Okay. Well, the idea being that if you have a trailing stop, when you get a position that just goes and goes and goes, you are in a position to stay with that trade longer. If you're in a position to stay with the trade longer, well, then the likelihood is that you're actually going to achieve possible higher profits. The longer the trade goes in your direction, the likelihood is that you have that opportunity. Now, some traders like to have a trailing stop because it gives them what they believe the locus of control. They believe that they are in control of their position, which means they feel as if they're in control of the market. For some people, that might be true, but actually it's a debatable point. It's a debatable point. And personally, I think that the better a trader can operate is normally when they have the ability to recognize that they are not necessarily in control of the market. Some people find it actually much easier to follow a trailing stop because of that locus of control, because they feel like they're doing something, so they have to move their trailing stop profit on whether it be 5 or a 15 or a 4 hour or a daily, depending upon your trading time frame and outlook, that they feel that it's easy to follow. They have involvement with the market, and they feel as if they are actually actively engaged with the market. And so some people find that easier to follow. What I can say is that that there is, once again, in the same way we had talked about with stop losses, the same is true of profit targets, that there is no perfection. People will try possibly to achieve perfection in terms of exiting profitable trades in a way to, let's say, squeeze as much blood out of the stone. But the reality is there is no perfection. Once again, a bit like we talked about with stop losses, it's about finding just a simple way that you can follow time and time and time again. That is the easiest way for you to operate. Okay, so let's just move on. I thought I had a question there, but what we talk about is that is effectively that, as I said, there's very little in the way of perfection. Now, for me, what do I use? Well, I personally prefer to use a target. Why? Well, because my background was in the military. In the military, you are trained to hit a target. I like to have my trade, know where I'm getting out when I'm wrong, and know where I'm getting out when I'm right, and actually just hit the target. And I can place the trade, and I can set and forget. That means I can go about my day. It means I can travel. It means I can meet clients, and actually my trade just plays away, and I have no desire to interfere with that. But as I said there before, there is no perfection. I'm going to give you a little example here, okay, that there's no perfection. So here's a trade from me. Admittedly, this is from a few years back, but this is a trade on the dollar-yen on the weekly chart. Those of you who know me will know I love the weekly chart. I think they're a fantastic chart to work on for longer-term trades. And what I had here was I had an entry here ordering the dollar-yen, which was around about the 82 handle on the dollar-yen. And hopefully you can probably see, price actually triggered and went up and hit its target just in front of the weekly 200 period moving average. And it was a nice profitable trade. The trade generated for me plus 3.7 units of risk. So it was a very handsome reward for my trade. I was very pleased. I had a good trade plan. I planned my trade. I traded my plan, and the trade plan worked out very nicely, and I was very happy. But actually, as you can see, ladies and gentlemen, That was the start of Abenomics, and as you can see, the dollar just strengthened against the yen, and the price went from whereby it was at about 85. We eventually hit 100, and even went beyond that. So in that particular case, I had a very, very good trade. I had a target for my profit, but actually, you can see that actually the trade went on and on and on and on. So I just wanted to share that to show you that there is no perfection. Okay, there is no perfection. Sometimes if you use a target, well, you'll miss out on a very, very long run. Sometimes if you use a trailing stop, you'll actually be taken out for less than if you'd got out at a predetermined level. There is no perfection. But what there is an ability to just follow a plan simply, trade after trade after trade after trade, and let the probabilities play out for you over a sample of 50, 100, 200, 300 trades. That is where the beauty is. Find something very simple that you can follow trade after trade, and that will serve you better than spending your time trying to find the perfect stop loss and the perfect profit exit, because I guarantee you they don't exist. So we talked about, let's say, physical exits, but actually now what I want to talk about is psychological exits. What does that actually mean, Paul? Well, there are certain times when you are nowhere near 100% fit state to trade, and you should be flat, pure and simple. What does that mean? That just means you shouldn't actually have a position in the market because you are nowhere near 100% fit state to trade. So let me talk you through a few of these because it's called life, and I will explain that as we go further on. So if you're going through a divorce or a separation of a relationship, this is not a terribly good time to be trading financial markets. These are what I like to call common sense exits, namely utilize a bit of common sense and stand apart. However, the interesting thing is humans, and I have to say especially we men, driven by our ego, we sometimes ignore common sense. If you're having a problem with, with your partner, or if you're going through a separation or divorce and there's a family breakup, focus on dealing with that. Don't try and hide your emotions by thinking you can trade your way out of it, because I assure you, you'll find it typically challenging. If you're starting a new family, or you're having an addition to your family when a child is born, or you have the passing of a significant person in your life, that is also a common sense exit. That is a time when you are unlikely to be psychologically sound, and the best thing you can do is to actually just stand aside, and maybe that's for a couple of days or a couple of weeks, maybe even a month or so. Stand aside, put yourself in a good place psychologically, and then come back to trade the markets, because that will do you more good than trying to, let's say, cover your grief with trading markets. If you find yourself moving home or office, that's another good time to just take a little bit of a psychological breather. I think they say that moving house is one of the sort of top 3 most traumatic events in our lives. So if you're doing that, my suggestion is focus on getting your house moved, focus on getting your trading station set up nicely in your new place, and then come back to trade markets. Trying to trade through moving house never works well, because there's always a lot of work goes on. It always involves much more than we think it'll take, and that let's say that emotional energy is best used on making your house move as painless as possible. The next common sense exit is when you're feeling psychologically exhausted or burnt out. Sometimes it does have to be said that it takes us a long time to realize that we're a little burnt out or exhausted, but you will know it. You will know it within yourself, because what will happen is you'll start to make mistakes. You'll get sloppy in your trading. You'll stop following your rules. You'll stop doing things like keeping records. All of that is a sign that you're burnt out. If you're burnt out, take a break. Okay? These last 2 weeks of August are normally a great time to effectively take a little bit of time out. Take a bit of time out to recharge the batteries, take a little bit of time to reflect on how you've done so far this year, and just give yourself a little bit of a breather, a little bit of a break, so that you're able to trade the rest of 2017 for what will be probably a very interesting remainder of the year. You're in a position to trade that well. Another common sense exit is if you're starting to get excited about your trades. If you're excited about a trade that you're in and you feel like doubling up your position, that's actually probably normally a good sign that invariably it's time to leave the party, time to exit. Why would that be? Simply because, you know, what happened is you're probably full of euphoria, you're full of confidence. Your ego is telling you that you're the top of the world, okay? You're the best trader in the world, and that actually, you know, what you should do is you should double up your position. And that is always a challenging place to be. And one of the final ones is that, you know, common sense exit is when you're on a holiday, okay? When you're on holiday, go on holiday. All right, that might sound very simplistic, but it's the truth. We've just talked about being, you know, a little exhausted, a little burnt out. Go on holiday. Switch the computer off. Enjoy being on holiday. Take time away from your work. Take time away from your trading. And I guarantee what will happen is you'll come back fresher, sharper, and more ready and more sort of in love with trading rather than being burnt out. Every so often you have to take a holiday and you have to take some time away. If, like me, you're occasionally away on business trips and you can't follow the market, well, then that's another good time to either be flat or just make sure that you know, don't try and trade. I know that we've all done it. We've all been on business trips and maybe a little bit bored in a hotel room at the end of the evening and think that, you know, maybe we'll just have a little bit of a look at what the markets can do, and that can actually, you know, that can while it will pass the boredom, may not necessarily be the best way for you to operate. So, just as I said, to finish up, some common sense exits there. If you're going through things like divorce or separation, or if you have the passing of a significant person, or you have a new baby child, all right? If you're having a newborn baby child, enjoy that experience. Don't be trying to trade whilst you have you're trying to feed the baby in the other hand. If you're moving homes or offices, okay, just make that happen well rather than trying to trade around it. And if you're feeling exhausted or burnt out, take a little break, okay? And, you know, maybe go on that holiday. And when you're on holiday, just focus on being on holiday. If you start finding yourself getting excited about your positions, okay, to the extent that you feel like doubling up, then maybe that's a time that you're showing a little bit of euphoria and overconfidence. And if you're on a business trip, okay, and you can't really follow the market too well, okay, because maybe the connectivity, or you're busy, or you're just racing from one meeting to another, racing from one airport to another, well, then that's a time to have a common sense exit for your trades. So to kind of finish up there, if you remember what we touched upon here is that we started off by talking about how there should be two simple rules that you follow in all of your trading. First rule, always live to fight another day. Doesn't matter, you know, what type of trader you are, or whether you've been trading for 2 days or 2 decades, you always live to fight another day. And what helps you do that is to ensure that you basically use a stop loss in all of your trades, and that you only risk a small portion of your account. The second rule is that you should never enter a trade without knowing your exits. You shouldn't be in a position where you just arbitrarily just hit the punch button and just get yourself into a position without knowing where your exits are, where to get out when you're wrong and where to get out with it when you're right. And finally, you should always know your plan for life's little challenges, okay? Life happens to us. It happens to all of us. None of us can escape that. So you should have a little plan for what to do, how to sort of manage your stops and manage your profits around those little life challenges. And if you do have a tough life challenge, don't try and trade through them. Take that from someone who's worked with traders from all levels, from tier 1 institutional traders through to beginning private traders. Okay, doesn't matter. No one is immune to that. We are human beings first and foremost. So if you do have a little challenge, if you have a new baby into your family, focus on looking after the new baby. Enjoy it. Enjoy that experience rather than trying to make it terribly stressful. So I hope you found that useful and interesting, ladies and gentlemen. If there's any questions, by all means, shout them out. As always, there's the Valutrades account representative will be happy to take your take your questions whenever you watch this. If you're watching this on demand, by all means, get in touch with your account representative, and they'll be very happy to help you with any conversation or any questions you have about stop losses and take profits, and also about any of your other trading issues. What I'll do for the last 5 minutes or so is I'll just have a quick look at the chart. So if you'll bear with me a moment, I'm just going to try and switch across the charts, and I'll just have a look at one or two of the big major indexes, just give you a little bit of quick insight, and then we'll finish up for the evening. I hope you found that useful. And as I said, just bear with me a moment, and we'll bring up some charts. Okay, ladies and gentlemen, I hope you can just see my charts there. Okay, this is the Valutrades MetaTrader 4 chart. I'm just going to quickly talk through one or two ideas or thoughts that are just on a couple of the big charts. Okay, just on a couple of the big charts to finish us up. This is the euro dollar chart. Okay, I talked a little bit of time. I'm going to take off one or two of these indicators. I talked a little bit earlier about about how we like to, I personally like to use the weekly charts. I think they're a fantastic tool to trade from. I'm a long-term trader. So here is the euro dollar weekly chart, and what actually happened is you can see that we've had just a great trend up there in the euro. Okay, the euro strengthened pretty much against everything over the last couple of months. We had the Macron bump here in April, and it's just showing no sign of abating. But what happened is we ran into the weekly 200 period moving average here. Hopefully you can see the green line there. And invariably now what we're seeing is price is a little bit blocked there. Okay, hopefully you can see that yourselves, that the price is effectively, it's been knocking around about the sort of 118 level. Of course, what you have to remember is we're in a little bit to the sort of the summer holiday, so the big boys are out sunning themselves on the beaches somewhere, and so invariably we see price just going a little bit sideways, but it won't stay there. I can assure you of that. What will happen is that as we get into September, what will happen is that as the big players return to their trading desks after their summer holidays, we'll start to see movement in that. But at the moment, we can see that euro dollar is, to my view, is just bouncing around about that 118 level, and that's where I see it congested there at the moment. So whilst that's it, let's have a little quick look at, hopefully we've got some of the pound against the dollar here, okay? One of the other big currencies that are traded, okay? So once again, it's the weekly chart. We can see that actually for the last couple of weeks, what happened is we had a, let's just draw in a little bit using some of the tools here. Realistically, what we had is, between sort of April and June, July time, we've had a little bit of a box all around the UK election, or rather the sort of pitiful results of the UK election. We had what we call like a false breakout here, okay, back in back at the end of July. We had a false breakout, price pushed up above 130 but closed beneath it, and then invariably what we've seen is the last few weeks price has just trickled down. And this is kind of interesting because the US dollar has been enormously weak against everybody over the last few months, and so to see even the dollar strengthening against the pound is a sign of let's say some of that sterling weakness that we've actually got to see here. Let's see if we can have a little look at the the DAX here. Should be able to hopefully bring it up here. Chart window up. Simple template on here. There we go. So what we can see here is this is the DAX. Once again, it's the weekly chart. Right, we hit some nice highs here. All right, there we go. Just you can see that hopefully yourself. After a I'm just going to draw a kind of very simple trend line there, right? And what we've seen there is the last few weeks is that as the euro has strengthened, that had an inverse effect on the DAX, and you can see for yourself that the DAX there has just trailed down. It's been some very big, strong selling weeks. Some people might see this as just being in a little bit of a flag pattern at the moment. There we go, just draw that in there. So people might see that as a bit of a flag pattern, so in which case you'd be expecting to see a break above that sort of 12,300 level to push back to the 12,950 zone. Or maybe, you know, we get down to the sort of 50 period moving average around here, about 11,800, 11,900, and we start to see if there's any interest in the market moving particularly lower. But as I said, you know, I particularly love the weekly charts because it makes it quite simple. You know, you get time to sit and watch and wait and look for your patterns, and then to be able to sort of build a very, very simple trade plan around them. Let's have a look at just the last couple. We'll just have a look at this is the Dow Jones 30, US 30 in your charts. Have a look at once again at the weekly chart. Look at this. It's, you know, it's been in an absolute tear there, okay, and a lovely move up, right? Hitting all-time highs there, 22,170, 22,180. But, you know, even that over the last couple of weeks, there's probably just been a little bit of profit taking over the summer holidays. But, you know, this week we can see that so far that profit taking has kind of abated, and now we're just knocking around about the 21,900 level. Once again, it'll be interesting to see how this, you know, happens for the next 2 weeks before we get back into the end of the year. There's, you know, there's a good chance that, you know, we may have a little bit of a price rolling over, but then again, you know, we might actually see price pushing higher for the remainder of the year. A lot of it, I think, is personally to do with Janet Yellen. She leaves the job in sort of January, February time, and my own view is that, you know, she's going to do whatever it takes to keep the markets moving north whilst it's on her watch. So that's the way I'll view it. She'll do and say whatever it takes to basically to keep those elements moving forward. So let's finish off with a little bit of gold. I appreciate some of you might be a trader of gold, and then here we go. So gold on the weekly chart. In fact, actually, for a change, I'm actually going to go out to the monthly chart here, as this is what I've been looking at. Just I've been talking about myself about actually how I saw gold on the monthly chart just starting to coil up there, okay, almost like a little triangle. And what's happened is we've not had a terribly convincing break out of that, but price has nudged its way north. There you can see price is up, and realistically, what I look at is, you know, price has to get above 1,300 to really convince me that it's a break to the north, and it's a strong break. And so that's what I'll be keeping an eye on myself. So I hope that helps. Just give a little bit of insight just to finish up this evening. I hope you found that all very useful for you, and that gives you some insight into both trading with stop losses and take profits, and also just having a quick view on the actual market. As always, if you've got any questions, we'll by all means shout them out or get in touch with the account representative. I wish you the very best of success in your own trading, and I look forward to speaking to you at the next Valutrades webinar. Many thanks and good night, everybody.